Hello viewers, welcome to my channel. I'm Hasham. Now I'm starting the last and final chapter of this financial management for BBA. The last sixth chapter consists of two parts. The first part, receivables management, and secondly, inventory management. Before this chapter number 5, I have completed two topics, that is working capital management and cash management. Hope my students have already watched those videos, got the complete command on working capital and cash management. So if you have not watched, I suggest you go to the playlist of my channel, select the subject financial management for BBA, select the videos of working capital, cash management, be thorough about those two concepts. Now before starting the explanation of receivables management, take the screenshot of the points which I have written on the board, then I'll explain. Now, receivables management. First of all, you must know what do you mean by receivables. Actually, receivables means the debt owed to the firm by the customers on account of credit sales. Nowadays, no business can depend only on cash sales because a lot of competition is there. It's very difficult to compete in the market to capture the customers. In that case, credit period has to be given. The goods should be sold on credit basis also. So when goods are sold on credit, receivables will arise. And this account receivable or trade receivable, this is the part of the current asset. So receivables are one of the major part of current asset of the firm. In any company, if you see the current assets, one of the important and significant current asset is receivables. Now the amount of receivables of the firm affects its requirement of working capital. The working capital, the factor which mainly affects working capital is trade receivable and inventories. These two are the major parts of current assets and it affects the working capital. Working capital means the ability of the business to meet the obligations on time. The credit policy of the firm decides the amount of receivable of the firm. The firm has to make a credit policy. What is credit policy? I'll explain you later. But the trade receivable or receivables depends on the policy, credit policy made by the company. And thus the credit policy and management of receivables becomes very significant. So in any company, the credit policy and receivables management, these two are very, very significant, very crucial for every business. And these two factors will affect the working capital, will affect the liquidity, will affect the profitability. So you can see how significant it is to manage the receivables. Now, meaning and definition. First of all, receivables are the debt of the firm by customers arising from the sale of goods and rendering of services. Every business, either it sells goods or render the service. When goods are sold on credit or services are rendered on credit, then amount is due from the customers. So receivables are the debts which are owed by the customers to the firm on account of goods sold or services rendered on credit. This is the meaning. Receivables are also known as account receivable and trade receivable. Two other names are there. The debtors or trade receivables or account receivables. These are the common synonymous names. Then in simple words, we can say account receivable is the money that a business has a right to receive. Account receivable or trade receivable is the amount which a business has the right to receive from the customers on account of goods sold on credit or services rendered on credit. Now, the account receivable, one of the author, Hampton, he says the receivables are the assets account. For receivable, it's a part of the current asset, representing the amount owed to the firm as a result of sale of goods or services in the ordinary course of business. In the normal course of business, when the goods are sold or services are rendered on credit, an amount is due from the customer. That is receivables, that is an asset. That's all. So I have explained you about the meaning definition. Now account receivable management. How to manage this account receivable? If we do not keep, that means if we sell the goods only on cash, no account receivable, no management of account receivable. But the problem is, in a competitive market, you cannot survive if you depend only on cash transactions. You have to conduct the credit transactions also in the present generation. Then, if we conduct the credit transaction, there are pros and cons, advantage and disadvantage. To manage that, we have to manage account receivable. Now, account receivable management is a process of ensuring that the customers pay their dues on time. Management of account receivables means it's the process through which we ensure that the customers will pay their dues on time. No customer should avoid the payment, should delay the payment. Every customer should pay the amount on time. That process is called account receivable management. It prevents the business from running out of working capital at any point of time. If we do not manage the trade receivable, what will happen? The business will face shortage of cash. Working capital problem will arise if we do not manage account receivable. Then receivables management contributes to the profitability by reducing the risk of bad debts. Suppose if we do not manage the receivables, bad debts will arise. Bad debts means irrecoverable debt. We sold the goods to the customer, but the customer has not paid the amount. That is bad debts. And bad debt is a loss. When more bad debts are there, the profitability will come down. So it is very much necessary that the accounts should be managed. Account receivables should be managed or controlled. The basic objective of management of receivable is to optimize the return on investment on this asset. Every investment wants the return. When money is blocked in inventory, return we require. Similarly, amount is invested in receivables. We should get optimum return on investments. So receivables management is concerned with getting optimum return on investment in receivables. And it is obvious that if a large volume amount tied up in sundry debtors, working capital requirement and consequently interest charges will be high. Suppose if we have more account receivable, what will happen? The money will be blocked. That means we have purchased the goods and sold the goods on credit. The credit period is given. So the customer will pay after the credit period. Till that time our money is blocked. So if we have more trade receivable or account receivable, money will be blocked. Interest charges will be high. Working capital problems will arise if we keep more trade receivable. On the other hand, if investment in sundry debtor is low, then the sales may be restricted since the competitor may offer more liberal credit. Nowadays, there is a lot of competition in the market. More competitors are there. In that case, even if we keep low account receivable, low sundry debtors, then what will happen? Our sales will decrease. When sales decreases, the profitability will decrease. The business does not want to decrease the profitability. The profitability will increase when sales are increased. Sales will increase when we give more credit period to the customers. So both are evils. Keeping high level of account receivable is not good, and keeping very low amount of account receivable is also not good. Both are evils. So we have to manage. There is a procedure how to manage the account receivable. Now, therefore, management of sundry debtor is an important issue and requires proper policies and efficient execution of such policies. That is the reason why the business must follow a policy, a credit policy through which we should not have either excessive credit nor we have very low credit. We have to manage the credit. We have to sell the goods on credit, and at the same time we have to manage it. We have to control it by making some policies, and it will affect the profitability and liquidity. Now, factors determining the credit policies. What are the factors that determine the credit policies? The credit policy of every firm. Now, before that, first we discuss about factors determining the size of investment in receivables. How much amount of investment should be made in receivables? What are the factors? The first factor, effect of credit on volume of sales. Check whether what is the effect of credit policy on the volume of sales. Suppose even if we increase the credit period, the sales are remaining same. So why to increase the credit period? We have to see the elasticity of demand of the products. If the products are inelastic, that means whether we give more credit period or less credit period, our sales are not significantly changing. So why to increase the credit period? Keep the credit period low. If the elasticity, if the complete elastic demand is there, in that case what will happen? More competition is there. If we increase the credit period, the sales also will increase significantly. In that case, we have to give more credit period. So it depends on what is the relationship between credit policy and the sales, right? Secondly, credit terms. What are the terms we are giving? That means how much time period we are allowing to the customers. Then thirdly, cash discount. Every firm will give cash discount if the customer pays the amount before the due date. So this is also one of the factors which determines the amount of investment in receivables. Policies and practice of firms selecting credit customers. We cannot follow the same credit policy on every customer. We have to analyze the customers because we have different types of customers. Some are regular customers, prompt customers, some are delaying customers. So we have to analyze what is the nature of customers do we have. Then paying habits and practices of customers. How the customers are paying the amount. Are they paying the amount on time or not? Similarly, the firm's policy and practice of collection. How we are going to collect the amount from the customers. What is the policy, collection policy we have? So these are the factors to be considered regarding the amount of investment in receivables. The degree of operating efficiency, billing, record keeping functions, etc. There are basically three aspects in management of sundry debtors. Sundry debtors are the receivables. Three aspects are there. The first aspect, the credit policy is to be determined. This involves a trade-off between profits on additional sales that arise due to credit policy being extended on the one hand and the cost of carrying those debtors and bad debt or losses on the other. The first aspect of sundry debtor is making a credit policy, making a credit period. That means we have to make a trade-off between benefit and cost. For example, if we increase the credit period, there is benefit and also there is cost. The benefit is when we increase the credit period, our sales will increase. When sales increases, profit will increase. That is the benefit. But the cost is more money will be invested in receivables. Lot of money will be blocked. Interest charges will increase. Apart from that, bad debts. That means if we give more credit period, there are more chances of bad debts. So these are the costs. So we have benefits and cost. We have to make a trade-off and check whether benefit is more or cost is more. If the benefit is more, we can extend the credit period. If the cost is more, don't extend the credit period. This is the first aspect of managing the sundry debtors. The second aspect of the management of sundry debtors is credit analysis, whereby the financial manager determines as to how risky it is to advance credit to a particular party. Now, credit analysis. First one, credit period. The second one, credit analysis. Individual. Suppose in a business we are having hundreds of customers. Do you think that all customers are of the same nature? No. We have to classify the customers. Some customers are very good customers in the sense they will pay the amount on time. They will not make any delay. Regularly they will purchase the goods. Whereas some customers are there who are irregular, who are not loyal to our business. Sometimes they will purchase, and even the payment habits are also not regular, not punctual. In this way we classify. If good customers are there, we can extend more credit period. Suppose if the customer's record is not so good, then we will give less credit period. Like this, every customer we have to analyze what is the nature of the customer. All the customers are not alike. Next, last one, the third aspect is to follow up the debtors and credit collection. Thus, the management of sundry debtor involves both laying down credit policies and execution of such policies. Not only we have to lay down the policy, but also execute that policy. Collection procedure should be good. A separate department should be kept for collecting the money from the receivables. A business may have so many customers. The record should be kept when the due amount is there for each and every customer. Before the amount is due, a reminder should be sent to the customer that amount is due, please pay it. Once the payment is made, that means the account will be closed. So all this follow-up procedure should be done. So three aspects. The first aspect is making a credit policy by making a trade-off between benefit and cost. Secondly, credit analysis of individual customers. And thirdly, follow-up procedure. So these are the three aspects in managing the receivables. Now, types of credit policies. Now, the credit policy of every company is largely influenced by two conflicting objectives. Every policy will face two conflicting objectives. The conflicting objectives are liquidity and profitability. Liquidity means ability of the business to pay the liabilities on time. If we have sufficient working capital, liquidity position will be good. So, if we keep very strict credit policy, then our liquidity position is good, but profitability will come down. On the other hand, if we give a liberal credit period, more credit period, then profitability will increase, but our liquidity position will come down. That's why profitability and liquidity are conflicting terms. If one is increased, the other will decrease. The business has to manage between these two. The liquidity should not come down and the profitability should be maintained. So two policies are there. A credit policy may be the following: liberal or lenient credit policy. Liberal or lenient credit policy is that policy where the company will give an extended credit period. More credit period will be given. Normally this extended credit period will be given in that case where competition is more. Where the competition is more and the firm does not have any liquidity problems, no working capital problem, then the company can go for liberal credit policy in order to increase the sales. In order to grow the business, they will follow liberal credit policy. Liberal means extended, more credit period. जितना ज्यादा क्रेडिट पीरियड देंगे उतना सेल बढ़ेगा, प्रॉफिट बढ़ेगा, लेकिन तभी देंगे जब मार्केट में कंपटीशन बहुत ज्यादा है, कॉम्पिटिटर्स ज्यादा पीरियड दे रहे हैं, हम कम पीरियड देंगे तो हमारा सेल्स कम हो जाएगा, इसलिए हमको भी एक्सटेंडेड क्रेडिट पीरियड देना है. Similarly, second one is stringent credit policy. Stringent credit policy or stricter credit policy means short credit period. We will not give much credit period, we will give very short period. This short period will give if the firm is facing liquidity problem. Suppose the firm is having working capital liquidity problem, then it will make strict credit policy, very short. ताकि जल्दी पैसा आ गया तो credit policy, the liquidity can be maintained. And also in the market there is not much competition. If competition is very less, then we can go for stringent policy. If competition is more, go for lenient credit policy. Like this, broadly we can divide the credit policies into two, that is liberal and stringent. Now, determinants of credit policy. Company objectives. What is the objective of the company? The company objective may be to maintain the liquidity or to increase the profitability. If the company objective is to maintain the liquidity should not fall down, working capital problems are there, then it will go for stringent policy. Suppose if the company wants to grow, the main objective of the company is to grow, increase the profitability, then it can go for liberal credit policy. So determinant is we have to find out what is the objective of the company. Second, economic conditions. Economic conditions like during the period of recession or slowdown in the economy, the people will not have much money. In that case, the business has to give some liberal credit period so that our sales will increase because economic conditions are not good. Whereas in the market, if it is a boom period, lot of money is there, why to give extended period? Will give stricter policy. So it depends on economic conditions. Industry competition. In the industry in which the company operates, what is the level of competition? What other competitors are following? Which policy they are following? That also will be taken into account. Customer profile. So before making a credit policy, we have to evaluate the individual customer. What is the credit worthiness, credit scoring of the customer? If the credit scoring is good, we can be able to give long credit period and favorable credit period to those customers whose credit score is good. So individually we have to evaluate the profile of the customers. Economic environment like interest rates. In the market, if the interest rates are increasing, then it will be difficult to procure the funds for making goods. In that case, stricter credit policy they will make. Stricter, so that immediately we can be able to get the money so that we can pay the loan as soon as possible. Interest charges will not be much. Next, internal financial position. What is the internal position of the business? Means liquidity problem. If the company is following liquidity problem, it will give stricter credit policy, short credit policy. If the company does not have any liquidity problem, it can extend to long credit policy. Next, legal and regulatory framework. There is every company has to comply the legal regulatory framework. Here we have to follow what the law says regarding the credit sales and collection from customers. Last one is product life cycle and profit margin. Product life cycle. If the product life cycle is very short, we have to extend less credit period, stricter credit period. If the product life cycle is long, we can give more credit period. Similarly, profit margin. Whichever product will have more profit margin, we can extend a longer credit period because profit margin is more. Suppose if the profit margin is very less, don't extend the credit period, give short credit period. So these are the factors, determinants of credit policy. Now last factor is factoring. Factoring is the outsourcing of credit control department to a third party. Nowadays, in order to increase the liquidity, we can sell the trade receivable to a factor. Factor is a person who purchases the trade receivables of the company. अब मेरी कंपनी है, मेरे पास सपोज एक 10 लाख रुपीस रिसीवेबल्स है. 10 lakh rupees I have to receive from all the customers at different dates. So instead of doing myself, I sell all these 10 lakh rupees of trade receivable to a factor. Factor will say, give me some 10% discount, I will pay you the amount immediately. तो पूरे 10 लाख रुपीस के ट्रेड रिसीवेबल फैक्टर खरीद ले रहा है, उन्हें immediately 9 lakh rupees दे रहा है. 1 lakh rupees fees he will collect, he will take charge. Now immediately we got the money. Instead of waiting and collecting from the customers, we have outsourced this activity to a factor. Normally factor is a bank. The debts of the company are effectively sold to a factor, normally to a bank. Then the factor takes on the responsibility of collecting the debts for a fee. Freely he will not do. The bank will purchase the trade receivable for a fee, and later on the bank will take the responsibility of collecting the money from the customers. Factoring is primarily designed to allow companies to accelerate cash flow, providing finance against outstanding trade. So it is one of the method of source of finance. The business, if it is having any cash flow problem or liquidity problem, they can sell the trade receivable to a factor and get the money immediately. So cash flow will improve, liquidity will improve. So this improves the cash flow and liquidity. That's all. This is all about factoring. The last topic is aging schedule of receivables. Aging. These two points are frequently asked in examination. What is factoring and what is aging schedule? When account receivables are analyzed according to their age or number of overdue days, the process is known as preparing the aging schedule. We have so many customers. We analyze all the customers and write it in a table according to the number of overdue days. यानी कितने कस्टमर 1 महीने से ड्यू है, कितने कस्टमर 2 महीने से ड्यू है, कितने कस्टमर 3 महीने से ड्यू है. According to the overdue days, we classify all the account receivable. This process of classifying all account receivable according to number of days is called aging schedule. The main purpose of classifying receivable by age group is to have closer control and quality of individual accounts. Why this aging schedule is prepared? To control the trade receivable, because if the amount due is for a longer period of time, there are chances of bad debts. So money delayed, money denied, that is the proverb. जितना जल्दी पैसा आ गया उतना certain है, जितना delay होगा उतना uncertainty increase होगा. So that is the reason why money should be received as soon as possible. To see the quality of trade receivable, it is better to make aging schedule. The calculation of average age of receivable is a quick and effective method of comparing the liquidity. Mainly aging schedule will help in comparing the liquidity position of the one firm with another firm or one firm over a period of time. That means last year and current year we compare what is the liquidity position. So this aging schedule will be very much helpful in knowing the liquidity position. It also assists from the predict the collection pattern of receivables in future. By analyzing this, we can be able to make policies, collection policies in future also. So this is the end of this video regarding trade receivable. In examination, you may be asked a theory question regarding the concept of trade receivable. So if you watch the video 2-3 times, definitely you can get the complete knowledge about trade receivable and confidently you can write in examination. So if you are satisfied, give a like to the video, share my channel among your friends, among your group so that more students can watch the video. Subscribe if you have not yet subscribed and comment from which city, which country you are watching my video, because my video is being watched all over the world in many countries. So I want to know from which country you are watching the video. And apart from that, I have started a membership club. In that membership club, exclusive videos I am going to upload for the benefit of club members. So join the club, membership club. Definitely you will gain to get a lot of knowledge from different category of videos. So inshallah we will continue the next topic in the next video.